All right, we have some new retail sales data. Receipts for retailers unchanged in March, according to an advanced estimate from Stats Canada released today, which followed a 0.1% drop in February, missing expectations for a 0.1% gain in a Bloomberg survey. And when you take it all together with a 0.3% decline in January, the figures are basically pointing to a flat reading on the retail sales front in the first 3 months of the year, which would net out to being the weakest pace since the second quarter of last year. For more on what that means for Canada's economy and interest rate expectations, Lesley Marks, Chief Investment Officer at Mackenzie, is back with us. So I think we've all kind of reached the conclusion. You said before the break that the U.S. economy has been quite resilient. People, by comparison, would probably see Canada less so. Mm-hmm. Do you think the retail sales would further inform your view on that?
It does. I mean, you don't like to put too much weight into one data point, but I did take a quick look at the retail sales numbers and the line by line, and I think it's important to see that where we're seeing pretty substantial negative declines is in a lot of the consumer discretionary areas like household goods, like clothing, like things that people, sporting goods, things that people, you know, they can put off. And that just further fuels this idea that Canadians are feeling the pinch of higher interest rates through their mortgages. And that hopefully gives the Bank of Canada what it needs to make its decision in June. And we think that this just aligns with a potential June rate cut.
And do you think there are some threads, because like sticky inflation seems to be the reason why central banks wouldn't want to say we are now officially pivoting, or fear that new forms of inflation come from committing towards lower interest rates. But I would think just the math of people being more reluctant to actually buy certain goods will play into a story of less inflation.
Mm-hmm. It's very important because the Bank of Canada, just like the Federal Reserve or any other central bank, has to forecast into the future. They know that their decisions have a lagged impact. So what the Bank of Canada has to do is kind of work their magic and say, well, in our crystal ball, 9 months from now, on this current trajectory, this is where we are headed. So even if you didn't think that right now was the time to cut rates based on the economy, because in their latest report, their latest monetary policy report, they actually increased the outlook for the Canadian economy. I think it was something like 1.5% expectation for GDP growth. So that might say to you, well, they don't really need to do anything. Things are moving in the right direction. But some of the signals, retail sales being an example, highlight that no, Canadians and unemployment, another one, Canadians are feeling the pinch here. And we have data that's on a trajectory that's not good right now.
So we'll watch to see what happens with the economy and with interest rates. I think having a direct comparison of what's happening with the economy and then looking at the TSX, which I know it's come off its peak, but it wasn't that long ago we got to a record level, might be a little bit misleading, because you've had, like, over the last month, we've seen gold stocks, the material sector doing well, even though they pulled back a little bit. Energy stocks doing well, even though they pulled back a little bit. So they've been a couple of stars this year. Industrials have lagged recently, but they have also been a standout this year. I mean, I guess it does feel like those sectors are benefiting from some themes that go beyond Canada's borders.
The Canadian stock market is not the Canadian economy.
Okay.
And what you just said around the TSX hitting new highs while the Canadian economy is trickling downwards is proof of that statement. There's only one data point, but that is the history. And so let's unpack that. Starting with the resources sector, which, as you said, across the commodities complex, we've seen strength in commodity prices for a couple of reasons. One, we know there's generally been an underinvestment in commodities, so there is a supply and demand aspect to that on the supply side. The second is on demand. We've actually seen a little bit of an uptick in economic growth from what is supposed to be the fastest growing economy in the world, which is China. That will be good for the commodity complex. It's part of what's driving oil prices as well. So that's good for Canada. Then you look at the dollar. You look at the weak dollar. Overall, commodities priced in US dollars, that's generally good for Canadian stocks. Any Canadian company that's primarily, a multinational or an exporter, that also benefits from the weaker Canadian dollar. Remember, costs in Canada, but revenues outside of Canada is positive for earnings. Even our financials, obviously the Canadian banking sector is important. We have some headwinds in the domestic market, but many of our large Canadian banks have very significant and growing, as a result of acquisitions, exposures outside of Canada. Where? In the United States. So again, a boost from the weaker Canadian dollar. So there are a lot of factors that are actually quite positive for the TSX. The U.S. economy, of course, we benefit from that. Now, we're not saying there aren't headwinds. Certainly, the election in the U.S. could present a significant headwind on the tariff front for Canadians. But right now, the earnings momentum picture is actually improving for Canadian stocks based on all of those factors.
It's good context. I was just making notes. I'm going to try to piece together a list of Canadian companies with a lot of that exposure to the currencies, or our audience. I was curious in that. I'm sure our audience would be curious to know, against all of this, the sector ideas you have right now. So when you look at the different sectors that make up the stock market here, you referenced a few of them. Are there any which you feel are poised for better performance going forward?
Well, I think the commodity sectors are certainly helped by stronger commodity prices, and it's a globally under-owned asset class group.
Yeah.
And underappreciated, frankly. It's been one of the top performing sectors or asset classes year to date, and it's significantly under-owned. The second area I would say that benefits, industrials is a bit of an eclectic mix of companies, but the right industrials that benefit from infrastructure build, Canada's spending on infrastructure, the United States on infrastructure, these companies will certainly benefit fundamentally. And that's what you're really looking for. You're looking for companies that have strong tailwinds, because you know that there are pockets of headwinds sprinkled throughout the global economy.